What a difference a single day makes. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And it's been a good day to be a macro trader. We said on this very show yesterday, US CPI ran the risk of surprising higher. And whatever that was going to do for stocks one way or another, it was going to eat into the Fed rate cut outlook, and it was going to probably be good for the US dollar. Boy, was it ever. Dollar surging across the board, and of course, stocks ultimately didn't like it. We'll see how they feel about it going forward. But what is it meaning really to say the dollar is up? Well, of course, it's up against the basket of currencies, but it's performing very differently against some versus others, though it is up generally. So what we're going to do today is explore where there might be some opportunities to trade this US dollar surge and where it might be perhaps a bit overdone already. So, with that in mind, we delve into the world of FX markets today because there is some interesting economic data on the menu here in the coming days that might shape the way that this dollar rally is going to move forward and have it advance differently in some pockets against some currencies rather than others. And of course, in that divergence, there is opportunity. So let's consider what we're looking at here. Not surprisingly, we can see what happened with today's release. CPI meaningfully stronger than expected. There's already a whole chorus of quibbling with the details, but ultimately it's the price action that matters. And what we find in the price action is that since the beginning of the year, stocks have pointedly ignored a rise in yields powered by falling Fed rate cut expectations. Note, this is a very different story from what was going on last year. Last year, when Fed rate cuts became less aggressive in the 2024 outlook, stocks fell. When they became more aggressive, stocks rose. At the start of this year, that story seemed to change. Stocks were still going up, still hitting record highs, even as rate cuts were coming off the board. And the question we were asking ourselves yesterday was, how many rate cuts are too few for stocks' comfort? Well, today, perhaps we got that answer. Yesterday, we were still looking for 100 basis points in rate cuts, or 1% for 2024. One of those cuts has now fallen away after the CPI data notched stronger inflation than anticipated, and stocks pointedly didn't like it. They swooned right here. So perhaps we've reached some sort of an inflection point. Maybe not. We're going to see whether there's follow through on this over the course of the next day or two. But of course, one place where this has worked consistently without the weirdness that we've seen in stocks, where sometimes they care about there being more or less rate cuts. Since the beginning of this year until today, they apparently didn't care. Here is a place where the macro works as expected. The green line there, the US dollar average against its four major counterparts, the top traded counterparts, euro, pound, yen, and the Australian dollar. And what we find is textbook. So when we have fewer rate cuts, the dollar gains because its yield advantage is bolstered. When there are more rate cuts, it declines because its yield advantage is undermined. Textbook stuff. What do we see since the beginning of the year? With diminishing rate cuts, there is a stronger dollar. Exactly what you would expect to see. Equity market shenanigans notwithstanding. And so what you see today as that CPI report gives us a readjustment to still fewer rate cuts in the outlook, a stronger dollar. Now, of course, I've made no secret of already holding long dollar exposure, being short the Australian dollar through 6A, being short the euro through 6E. And all of those things suffered today. The Australian dollar suffered in particular. The Canadian dollar did as well. So did the euro. So did virtually every currency. But one that was surprisingly less hurt than the others was the British pound. It fell less than 0.5% against the dollar. And the reasons why make it an interesting candidate to focus on, because, of course, we also have some key data out of the UK today, in just a matter of hours here, coming out in the morning UK time tonight for the US, that is going to test the British pound's impressive resilience here. That is, of course, UK CPI data. The expectation is that we're going to get an increase. CPI seen going up from 4 to 4.2%. That will be the first back-to-back month of gains. Of course, in December, that 4% was itself an increase from the 3.9% in the prior month. And that sequence of 2 consecutive gains in CPI will be the first such thing since October 2022. So we have a situation here that seemingly speaks to why the pound might be stronger, because, of course, that sort of a thing would diminish rate cut expectations. And indeed it has. If we take a look at the implied futures policy rate curve, this is backed out from 1 month SONIA futures, the UK equivalent essentially of Fed funds futures, we can see that the implied policy curve has shifted up significantly, in particular from the mid-year point onward, relative to where it was when the BOE last met, February 1st, that's the small dotted line there. And of course, the December BOE meeting, that's the big dots line there. We can see the path now significantly steeper. There are significantly fewer rate cuts in this outlook. We're seeing coming down from 5.25 rather, that's the current policy rate, as of even 2 weeks ago. The expectation was that by the end of the year, we'd be down at least 1%. Well, now it looks like it is going to be meaningfully less than that. Now it looks like we're maybe coming down something like 50 basis points. And we can see that here. Here's the spread between these futures, December backing out to the current contract. And we can see that whereas in January, we were looking at almost 150 basis points in cuts. That's the waning days of December is that peak at negative 1.44 or 144 basis points. If memory serves, that's December the 28th that peak occurs. And now we're at 50 basis points. So clearly almost a full percentage point in cuts has fallen away. So it isn't surprising, really, that the Bank of England outlook is helping the pound to hold up here better than other currencies where more rate cuts are on the menu. To put this in some context, if we compare this to the situation in the euro area, say, over there we're looking at 140 basis points in cuts. And, of course, in the U.S., it's diminished as of today, needless to say, but it is still a significant amount more. We're still looking at 79, 80 basis points in cuts out of the U.S. As compared with 50 out of the UK. So again, not a shocker that the pound is doing relatively well here. Having said that, the recent trend in UK economic data has been toward underperformance. This is the Citigroup Index of data outcomes relative to expectations. And just as the US version of this index is pointing increasingly higher, hence the positive data surprises we've seen over recent weeks, giving us the kind of adjustment in Fed policy odds and the stronger dollar, here we're looking in the opposite direction. Economic data now seems to be undershooting by an increasing margin relative to forecasts. Over the course of perhaps the past 2 months, this has been increasingly deteriorating. And so what we find here is perhaps the ingredients for a downside surprise. And if that occurs, well, then the pound's resilience is going to have to be shaken somewhat. Because if there is a softer than expected CPI number, well, then 50 basis points seems like too low a number. And we might have to shift somewhere closer to perhaps 70, 75 basis points. And then we'll see how we go from there. What this means from a practical perspective is looking at 6B futures here. We can see certainly the dollar is stronger here. We can see that, but we're still well above what is support. So if we're looking at where this recent range has been holding, it does look like we've broken the inner bounds and we're starting to extend lower, but we're real close to where this initial break didn't find follow through before. If the number is soft and we manage to push through and take this level out, though, well, then perhaps the reversal is indeed in place, and we can start to make good on the push through the bounds of this rise, perhaps all the way down here, sub 122 into the 121 and upper 120s area. But to do that, arguably, it's this level here that needs clearing. And perhaps this gives us a little bit of an opportunity to trade US dollar strength in a pocket where it hasn't quite unfurled to the extent that it's appeared in something like 6A, 6E, or for that matter, 6J. And this is the next part of our conversation here. Because just as we're going to get UK economic data, we are also going to get Japanese economic data. And here the situation is quite interesting as well. The focus on the fourth quarter GDP report, and the expectations are for a return to growth. The annualized GDP growth rate seen rebounding into positive territory, returning to expansion mode at 1.4%. That's, of course, a vast improvement over the 2.9% annualized decline in the third quarter. That was a very, very disappointing outcome. And what we have here is basically a return to form. As we can see, if this is sort of the COVID volatility in growth, here's the initial lockdowns, here's the catch-up growth after those lockdowns are starting to come off. That growth then moderates, and we establish something like a baseline here, just above the zero line. And you can see we've been oscillating basically between, let's say, 2.4, most recently 2.9, but something around there, and positive growth of, let's say, 4.5% to 5%. So we have about 3% loss, let's call it, on the downside, and 5% gain on the top side, which of course evens out to about an 8% swing range, giving us 0.4 then leaves us somewhere right in the middle. And so with that in mind, this would be a relatively middling out. A welcome rebound, certainly, but not anything that screams runaway gains. If we look at the components of GDP, and these are strictly quarter-on-quarter numbers, not annualized rates. So the third quarter number here is a decline of negative 0.7%. You can see the big standout here is that not only do we have a loss of domestic demand in the third quarter, which incidentally follows a loss of domestic demand in the second one. That's something that continues to be a hindrance for the economy and a reason why it has been so difficult for the Bank of Japan to really back off its dovish stance. It has inflation, but not the kind of inflation that it wants, which we'll explore in just a second, because domestic demand is in fact still weak. But whereas in the second quarter, there was a pop in exports, it wasn't so much there in the third. In fact, exports actually detracted from performance. And so the story here, as these GDP numbers will come out, is does domestic demand rebound in the fourth quarter? Because one key feature of the fourth quarter, of course, was a very strong yen, as interest rates were coming down virtually across the entire global economy, as markets were angling for Fed rate cuts through November and December. The yen, which tends to move inversely of global yields, absolutely surged. And so what we then saw in the fourth quarter was more purchasing power for consumers because of a stronger currency, while at the same time, more of a hindrance for exporters because their yen-denominated goods then became more expensive for foreign buyers. Now, these things tend to work with a lag. So it's unclear that this is necessarily going to show up now in this fourth quarter report all at the same time. But that will really be the question because, of course, as ever, the markets are speculating about the possibility that the Bank of Japan might shift policy in a more hawkish direction, something I don't think is a meaningful adjustment and have made no secret of saying as much. But nevertheless, the kind of data and the kind of adjustment that reinforces the idea that while everybody else is cutting, the BOJ is not. Take a look at this situation on inflation, and it starts to make sense why. CPI is, of course, elevated at 2.6%. That's well north of the 2% objective. But the overwhelming lion's share of this is imported because overwhelmingly most of this inflation is food. Japan, as it happens, grows less than 40% of the food that it consumes. Most of it is imported. It is, of course, an island. So that makes sense. With that, you have tremendous sensitivity to global food prices, which have been significantly higher post-COVID and which are only coming down with about a 7-month lag. So we can see here that first, food inflation has legs to continue coming down because there is this tail here suggesting that this has yet to make it into CPI and is moving with a 7-month lag, so there will be more of this filled out in the months ahead, which should give us more of this come down as well and continue to pull Japanese inflation lower no matter what happens domestically. And so with that in mind, we probably don't have an aggressive BOJ in the cards, or certainly not as aggressive of a BOJ as the markets might be angling for. They were terribly disappointed when last week Deputy Governor Uchida of the BOJ came out and said, essentially, yes, we're probably going to get off negative rates to some extent. Yes, we're probably ending yield curve control, or at least diluting it to a significant extent. But there's not a strong hawkish pivot from the BOJ that's in the cards until inflation seems to be wage driven, domestically founded, and thereby sustainable. And that's not what we're looking at here. So whatever this GDP number does, it seems unlikely to move the BOJ significantly, even if it is a pickup in purchasing power for consumers, because we can see that domestic element isn't really where inflation is coming from. The lion's share is external, and that process, put simply, continues. All this GDP number has to do, though, is really remind people that of all the central banks cutting, the BOJ is not. We can see here in the rates implied in overnight index swaps that although this pathway forward is a modest one, over the course of a year, we're looking to basically issue the equivalent of 20, maybe 23 basis points in hikes. So you can see the current policy rate is still a negative 10 basis points. Within a year, we're looking to get to a positive 10, 13 basis points. So maybe at the next policy meeting, it looks like we're getting off negative territory and approaching zero. Somewhere in the next 1 to 3 months, we then hold here for essentially the bulk of the year until by the end, maybe we get a hike. So very, very modest, very, very timid, but not a cut. Whereas every other major central bank is in the market to be cutting by 50, 75, 100 basis points, depending on what you're looking at. In the US, it's now 75 or so. In the UK, as we've just said, it's 50, but could go to 75 after the CPI data, or closer to it. In the Euro area, it's between 125 and 150. In Australia, let's say, it's something on the order of 25 to 50, closer to 50. But we're not doing that in Japan. Instead, we are timidly, but going in the opposite direction. Now, the yen, of course, got clobbered amid US dollar gains. But unlike the pound, here you might see a bit of a respite, because if this GDP data reminds investors that the BOJ is the only game in town where there are no cuts in the outlook, just as we are flirting with this very important swing bottom on 6J, we might be approaching something of a turning point. And so, while the pound might be a place of latent US dollar strength, the yen might be a place of returning US dollar weakness, as monetary policy divergence gives us very different outcomes for the dollar depending on which counter currency you choose. And that is Macro Money for today. As ever, we are here after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at how Wall Street finished the day and what is likely to come next. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, @Ilya Spivak. Thanks very much for joining. Macro Money is back tomorrow. See you then.